In this video, we're going to be looking at the capital and financial account. The capital account is largely insignificant and not really talked about, but the financial account is really important because that's the account that we use to fund the current account. So Australia has current account, always in deficit, financial account, and therefore is always in surplus to fund the current account. Capital and financial account is broken into two sections, the current account and the financial account. You'll also hear it referred as the CAFA. The capital account records one-way transactions where no exchange takes place. It includes migrants transferring their assets into an Australian bank. So if someone was to migrate to Australia, them transferring their assets that they had, their cash, into an Australian bank would be an example of a one-way transaction in the capital account. If somebody was to migrate from Australia to another country, that would be an example of a debit. It also includes debt forgiveness. So if we owe a certain amount of another country a certain amount of money and they decide that we don't need to pay it, it would belong to the capital account as well. It also includes non-produced, non-financial assets, copyrights, patents and trademarks. I wouldn't worry too much about what all that means. It's not very relevant. Financial account is really important. That's how we finance our current account deficit. So if we have a current account deficit, we're spending more than we're earning, and G&E essentially exceeds GDP. This must be financed, and we can finance, if we're spending too much, we can either finance it by issuing loans, or we can sell Australian assets, equity. They're our two options. So every time we have a current account deficit, our net foreign liabilities will increase. And our net foreign liabilities we'll talk about more in the next video, but it's a measure of our total level of debt plus equity that we owe to other countries. Financial account, if Australia experienced a CAD of $46.8 billion, so a current account deficit, that basically means that we spent $46.8 billion more than we earned. And so we spent more on imports, on servicing our foreign liabilities, so on our interest on our debt, than we received from selling exports, and that we receive from the earnings on our foreign assets, so like dividends that we get and all that kind of stuff. This $46.8 billion shortfall needs to be financed either by taking out loans or by selling Australian assets, and that will lead to an increase in our total liabilities. So we basically spend more than we earn, therefore we either sell off our assets or we go into debt, and we owe other countries more, or they own more of our assets. Anytime that we issue a loan, or we take out money for a loan, or we sell off our assets, that will be recorded in the financial account. So if we keep borrowing, the financial account essentially has a surplus because we keep getting money into this financial account to fund the current account. Sections of the financial account. Okay, 4 different sections. You need to be aware of official cash flows, non-official cash flows, and direct and portfolio investment. These two are related to debt. These two are related to our equity. Official capital inflow is when the government basically borrows money. If we run a budget deficit, so at the moment we're running a budget deficit of about $32 billion, what that means is that the government is spending $32 billion more than they are earning. The tax that they're collecting is insufficient to pay for their expenditure, and therefore they have to borrow money. And if they decide to borrow money from overseas, which is one of their options, they will sell bonds. They will issue a bond to, say, China. China will give us money and we will pay them back in the future. This is an example of official capital inflow, the government borrowing money. Official capital outflow is if the Australian government were to lend money to other citizens, either the government or private residents overseas. Very rarely does the Australian government do this because we're in so much debt, but if we were to, that would be a debit. Okay, credit is what, this is the key thing. Credit is when we're borrowing money because we're getting the money right now. It will hurt our current account in the future because we have to pay more interest, but for right now, if we're borrowing money, that is a credit. Non-official capital inflow and outflow, this is the borrowing and lending between Australian and overseas residents. It's got nothing to do with our government. Okay, so if private individuals are lending money to other people, that would be an example of a debit. If private individuals are borrowing money to fund investment, to grow, that would be an example of a credit. So Australian residents borrowing from people overseas is the non-official capital inflow and outflow. There is a lot of non-official capital inflow because Australians rely on money to invest. So we go into debt because we have inadequate savings, and therefore we use that money to invest, and that leads to an increase in credits in our financial account because money comes in for us to use. Net direct investment. Net direct investment is a form of equity financing. So if we essentially spend more than we earn, what we might do is, instead of going into debt, we might sell off some of our assets. So credits would be if we let foreigners purchase more than 10% of Australian assets or 10% of shares in a company. So if BHP was to sell off one of their divisions to Japan or America, that would be an example of a credit, because they would collect the money from that company. If Qantas decided to go split and go half and half, so half foreign owned, that would be a credit. So when we sold Vegemite, that would have been an example of a credit in the net direct investment. All to do with allowing businesses to set up operation in Australia or purchasing Australian businesses. Debits would be the opposite. If I was to go overseas and set up a venture overseas, that would be an example of a debit. Or if I was to invest in a foreign company, assuming I had more than 10% of the shares, that would be an example of direct investment. So a new oil field opened in Papua New Guinea by an Australian company, that's a debit. Net portfolio investment, it's the same thing, but it's less than 10% of the shares in a company. Okay? So it means that if a credit would be if sales of shares in Qantas to a foreign household, because Australia would receive the money. Debit would be a purchase of shares in Apple by someone over here. And this doesn't include any of the dividends, that's all back in the current account. This is when we're initially selling the property or initially selling the shares to other countries. Okay, you'll see this in your books. It separates it nice and neatly into official capital inflow and outflow. The non-official area, these two represent the two debt transactions, and then you've got your two equity transactions. You can see here that every single year we have lots of capital inflow, and that's to do with the fact that we are essentially borrowing a lot of money. So the orange represents the debt that we're issuing, and the blue represents the equity that's being issued.